You're watching the program that identifies market trends, provides insightful analysis, and reliable research. Key elements to help you profit from the pros. Profit from the Pros is brought to you by Zacks Investment Research. Learn more by visiting them online at Zacks.com. Welcome to Profit from the Pros. I'm Terry Ruffalo. The optimism that we ended the old year with continued right into the new year this week, at least for the early part of the week. A major dose of upbeat jobs news helped fuel that optimism. A little bit of a disconnect in that jobs news came on Friday on word that while the economy created fewer jobs than expected last month, the unemployment rate dropped to 9.4%, its lowest level in more than a year and a half. And after a positive, very positive ADP report, the market just didn't know how to digest that headline number on Friday. Helping also were minutes from last month's Fed meeting, which contained no major surprises and a better than expected factory orders report. Major averages continue to hit fresh two-year highs. Materials, food retailers, telecom, financial, and autos were among the stock groups in focus this week. But many stocks of big retailers fell after the retailers themselves reported weaker than expected December sales figures. So I don't know whether I should use that extra champagne bottle I've got in the refrigerator over this news or not, Steve Reitmeister. A lot of optimism that the market's going to continue to go higher from here. Certainly no doubt about that.
Yeah, I've read a lot of year ahead, outlook reports from different brokerage firms and investment experts. And the majority have upward bias on the year, because they do see a pickup in the economy, which is good for corporate earnings, good for the stock market. But to say that it's all going to be rosy and it's going to be a smooth ride, probably not the case. You take a look at, there's still a lot of very bearish people out there, a lot of folks who just think that the day of reckoning just hasn't come yet, that we've just printed so many dollar bills and issued so much debt that we're, the kick the can down the road concept that sometime in the future we will have to pay for it, and it will come at a very hefty cost. And so I think that when things start to get a little bit better with the market, you'll see some of that pullback because I don't believe that pessimism is gone. Okay.
Well, the big focus this week for investors seemed to be all of this jobs data that we got and are now trying to digest. And so now that that's out and we're looking at that in the rearview mirror, where might their focus turn? Or are they going to continue as part of their focus digesting that news?
Yeah, jobs is definitely going to stay in the forefront. You always get the weekly jobless claims, but take a look at next week. It's going to be all about earnings, and earnings season kicks off. And so, next week we get a warm up to earnings season. We get a few nice reports, but then the following week it gets big time. A few other things that are going to come up next week that definitely going to want to keep an eye on is we got PPI and CPI to tell us about the inflation picture, and are we taking more steps further away from deflation? I believe there's also industrial production next week and retail sales numbers and consumer sentiment. So all decent material. So it's going to be a jam-packed week next. Coming up, and definitely some market movers in there.
All right, let's talk about earnings season, one of those that you mentioned. I know we've talked about this before, but it never hurts to repeat it around this time of year. Why is earnings season such a critical time for investors?
Yeah, people get lost in all the data that's out there, and they take a look at the stock chart, and they take a look at all these different data points about stocks, but you got to pull back to the big picture. When you are buying shares of stocks, you are buying ownership stake in a company. And what owners of companies care about is walking away with profits, okay? And so 4 times a year, every 3 months, we get this report card on how earnings are coming out, and it gives us a picture of how it should be in the future. That picture of the future is what we are paying for, okay? That ownership stake of that future stream of earnings. And so, nothing moves that stock price more than these earnings reports, and that can be higher and lower. So it's the most critical time of year to really get an assessment of where the companies are at and what you should be paying for them based upon their future earnings streams.
All right, and when we hear about earnings season, we often hear the term whisper number thrown around. What is the whisper number?
Yeah, that's a very elusive concept that a lot of people have tagged different meanings to. But what they're trying to do is, because this is such an important time of year, okay, people want to try and get an edge of what stocks are more likely to surprise. Okay, have a positive surprise, buy those in advance. So the whisper number is kind of the sentiment that is not known. The insiders know this information and trying to get a leading edge. Most of these concepts have failed over the years, and it really kind of is the holy grail of investing to get an effective whisper number. Our firm's Zacks Investment Research has spent the last 3 years working on that, and indeed we believe we have found a very effective way of picking earnings surprises with 78% accuracy of knowing which stocks are going to have big earnings surprises.
So I'm guessing among all of the whisper numbers that are whispered out there, that's the data that you just mentioned that you focus in on.
Yeah, I mean, let's put it this way.
Quickly.
Yeah, the folks who know what's going on are the analysts. The sooner, the nearer you are to the earnings report, the more accurate that information is. We try and focus in on those analyst estimates nearest to the earnings date.
All right, thank you. Stay with us, more still ahead. Here is your Bull and Bear Stock of the Week. Well, we are back with our Bull and Bear of the Week here in this new year. And this time around, a construction company and a consulting firm make up those two characteristics of the two different stocks we're going to look at. Shiraz Mian, our research director, back with us once again for another season of Bull and Bear of the Week. Let's get to the bull first. Joy Global, that's the construction company that I was talking about. What makes this a bull?
Mining. Let me correct you there.
Oh, mining?
That's right.
I'm sorry. I saw the classification as construction.
It's a mining machinery, and the one word for why we have it as the bull of the week is the commodities.
Okay.
The commodities, as folks know, they have been on an upturn, particularly since the second half of 2010. Primarily when the Fed came out with its quantitative easing program. And we have many commodities, coal, copper, iron, gold, all of these making new highs or getting close to the prior highs, some making all-time highs.
And what do they mine?
Joy Global produces the machinery that mines those commodities, so they are right in the mix of that. Their business lags a little bit than the movement in the commodities. The commodity prices rise. The commodity producers, they use their excess equipment first, and once that's all gets used up, then they order fresh ones. They are one of the leading ones. Globally, their order flow is improving. The visibility for the outer years is significantly better than it has been for a number of quarters, and that's showing up in earnings estimates. So one additional thing I want to point out about Joy Global is that about half of their revenue, about 40% of the total, comes from aftermarket sales and maintenance, which is a more stable source of revenue for them. About 55–60% comes from sale of new equipment. About 40–45% comes from maintaining, repairing, parts, supplies, services of that nature. So a very good, solid name to play the commodity story.
Okay, we'll have to keep an eye on those rising commodities and all the ancillary companies that can benefit from that.
That's right.
FTI Consulting is the consulting firm. I know I got that right because it's in the name of the company.
That's right.
Why is this one not so great?
They have a good business. These guys have 4 or 5 different business segments. The biggest business is this corporate finance, corporate restructuring business, where they help out companies that have fallen on hard times. Now, you would expect that in these tough times, a lot of companies would have fallen on hard times, which should benefit their business. Yeah. But it's a little bit counterintuitive as the credit markets have improved and these distressed companies have access to credit in the bond market as well as from banks. That reduces the extent of distress that these companies face. So there are fewer corporate restructurings, fewer bankruptcies, fewer Chapter 11, Chapter 7 finance, and that's basically hurting FTI Consulting. The outlook for this core business, which accounts for about 40% of the company's business revenue, is not expected to come back anytime soon. There are other businesses. They have technology. They have econ forecasting. Those are doing good. But this core business is keeping them down. And my sense is that that will continue to show up in their estimates. That's the reason for being the bear of the week.
Okay. Stock Talk right now. And now, Stock Talk, analysis of stocks in the news. Well, in what's being called the most significant real estate expansion of the year so far, Dollar General Corporation says it plans to open 625 new stores and hire more than 6,000 workers this year. The company says the store openings will be primarily in the 35 states it currently operates in. And that news prompted us to want to take a closer look at Dollar General stock, and here to do that for us are stock strategists Tracy Reinick and Mike Vodicka. Tracy, I'm going to start with you because this news comes at a curious time to me, because just earlier this week we had Family Dollar Store announce bad earnings. So, and they're a big player in this dollar market.
They are.
So could we be seeing a time when maybe the dollar store industry is losing that economic tailwind?
Well, it depends on kind of where you are in that sector. Dollar General is a little bit smaller box stores, and it's competing a little bit more against the supermarket chains. It sells a lot more of the consumable goods than like the games and the toys and things like that that like a Family Dollar might sell. So it's become kind of a supermarket of choice for many people, and this expansion is kind of adding on to that because they're expanding in all the markets, the rural, the urban, and suburban, and there is real demand for that. They're also seeing, you know, with the lower price model that they have, with some parts of the economy still struggling, they're able to still cash in on that segment, especially in the food category.
So both of you guys have been looking at the stock for a while now that I know about. And Mikey, as far as the technicals are concerned here, I mean, we're looking at a stock price that is well within the 52-week trading range of the stock, and a chart that seems kind of flat to me.
Yeah, it's been a little bit of a bumpy ride recently. Over the last couple of weeks, shares have sort of consolidated, like you're saying right now. But interesting, what I thought was interesting that you mentioned is that we've actually did see some weakness in their share price over the last couple of weeks or so ahead of this news, and it does tie into what we've seen happening in the industry right now. People are questioning, are they at the top end of their margin cycle? Is the market getting saturated? So right now, as it stands, we're looking at a 3-month chart right now. Dollar General is sort of in neutral territory. The longer-term trend would be up. They've only been listed for about the last over a year. They went public in November of 2009, but the longer-term trend still looks good. You see that on the 15-month chart we have here. But right now, it's more of a neutral forecast, I'd say, on the chart.
Well, you've got a market cap here of $10.25 billion, just over $10.25 billion. So they're sitting on a decent amount of cash, apparently, to be able to pull off this expansion. Right? I haven't heard that they're going to be taking out loans for this.
No, and the expansion is kind of common with these stores. I mean, this is great news, and actually they already revealed it to the analysts a couple weeks ago, but this came out with the new year and like, look, we're adding all these jobs, and they've added, if they add the 6,000, as they say they're going to, they've added 15,000 jobs in the last 2 years. So these are like great headlines. But these stores, they tend to close some that are underperforming, then they're opening some. They're also remodeling some because some of the older stores, get a little old. But yeah, I mean, the rest of their fundamentals look really good. They're not trading at real expensive price here, and they had record sales in this last quarter. So things, despite Family Dollar's kind of issues, things still look good in this sector.
And they hiked their guidance too.
Yes.
When they reported earnings.
Yes, they raised the full year. So, and we're going to kind of see, we did just get Family Dollar's results a month after Dollar General. So what happened in that month is kind of the key.
All right, we'll keep an eye on it. Thank you both. We're headed to the round table next, and you'll want to listen to that. Stay with us. Welcome to the Zacks Roundtable Review, a discussion of current events affecting investors as well as other topics of financial interest, featuring the analysts and editors of Zacks.com. Jobs data aplenty and bumping up against another earnings season, plus top stock picks of the week. That's what we're going to cover here at this week's edition of the Roundtable with our editor-at-large Steve Reitmeister, research director Shiraz Mian, and that market technician Kevin Matris, who obviously didn't get any new ties for Christmas. But that's all right.
They're coming.
That's okay. All right, we got a lot of jobs data out this week. No shortage of it. A lot of reports. And in the beginning, when the reports started funneling out, everybody was happy and ready to pop the champagne corks. And then came Friday morning's news, which was, as I said at the beginning of the show, a little bit of a disconnect because didn't really hit the mark of what everybody was expecting. Shiraz, I'm going to start with you on this one. How do you feel about the unemployment news that came out on Friday versus all of the other jobs news of the week? Good news or on the weak side?
Definitely on the weak side. I was disappointed. The street was looking for something in the 150 range, which had actually increased a little bit from the 135, 140 range.
You mean jobs added?
The jobs added. But personally, I was looking for north of 200,000. So to me, it was a huge shock that all these positives that we are seeing in the economy, the ADP number is good, the initial claims numbers are coming out, both the ISM indices, their employment components were showing steady gains, and we've been seeing positive numbers on the retail sales number in the holidays too. Everybody on the street had been raising their forecasts for GDP fourth quarter as well as out into 2011, and then we get a number which is essentially indistinguishable that we had been seeing all through 2010. So a big disappointment. The takeaway in my view is that the trend that we were on in 2010 still remains in place. And the inflection or turnaround that all of us were hoping for to see, where we would move to a different trend level, that you would have 200,000+ monthly job creations, we are not there yet. And that's the key takeaway. So in a nutshell, I've been disappointed with the December number.
All right, Kevin, how about you?
You know, I'm not as disappointed as Shiraz and a lot of the other analysts I'm reading, because I look at this number as just one of three numbers we had gotten over the last 2 weeks. So if you were to go back to jobless claims the previous week, that was our first sub 400 number. We had 391,000 new claims. It was the best reading in about, I think, 2 years. Then we followed it up on the week of Christmas, where we had like 409. That was also a very good reading. And this is important because you need to see a reading of new claims of between the low fours and the sub fours in order for new job growth to offset job loss. So this is definitely a very big improvement. And I think that bodes well for future numbers. Now, it is true that Friday's employment report was kind of a disconnect from ADP. ADP showed 297, 3 times what everybody was expecting. However, I believe that the government's numbers, I think they are kind of undercounting it. They had to revise the previous number up by 20,000. Who says they won't revise this number up next month by another 20,000? So when you factor in that fudge factor, I think that you're going to see the BLS number kind of look similar to the ADP in the coming reports.
All right, Steve, despite Kevin's optimism, is it finally the long-awaited hiring boom has arrived?
I don't think we're ever going to see, or not ever going to see, I don't think we're going to see a boom. I just think we're going to see a steady improvement in the information. And before we started taping, we had a bit of a conference about this, and what is the difference between the way ADP reports the numbers and the government does. And the government's method is a survey, and it is prone to revisions after the fact. So this month they reported that October and November actually was, 70,000 jobs better than previously stated. I think we're going to see a similar type revision for this December number. What's important is the trend, and the trend is improving, and the jobless claim numbers are coming down, and indeed that will mean lower unemployment rate in time.
All right. I don't want to get too far out here because we want to talk about earnings season coming up here in the week ahead. U.S. corporations set to report their most profitable fourth quarter on record, according to published reports. Shiraz, what are you expecting?
Yeah, it's supposed to be a continuation of what we have been seeing in the prior quarters in this recovery. And I think the standout element in this post-Great Recession recovery has been the corporate profitability. We are on track by the second quarter of this year to basically match or go above the prior peak in earnings, which was in late 2007. So the earnings picture has all along looked extremely good and that trend will remain in place in the fourth quarter as well as into 2011. So I'm not particularly concerned about the earnings picture. With respect to the market needs to see an improvement on the labor side. And as long as we don't see that, the earnings picture just by itself will not cut it.
All right, Steve, give me your top stock pick of the week.
Yeah, going from the concept of an improving employment picture equals an improving consumer picture equals good news for retailers, I think, in the year ahead. And that's why I'm going with Fossil, which is a maker and retailer of watches.
Right.
And a nice little pullback in the retail group, where it's kind of profit taking after a strong holiday season. I think it's a great time to get in there and could easily see a 20-30% higher 6-12 months down the road.
All right, quickly, Shiraz.
T. Rowe Price is my top pick. I'm looking for a reversal in the money flows into bond fund, into equities right now. The last 2 years, money has been coming out of equities into bonds. That trend is reversing. We are seeing some early signs of that. T. Rowe Price and other equity-centric money managers are in the forefront of benefiting from that trend. About 2/3 of their assets under management, close to $440 billion, are in equities.
All right, even quicker, Kevin.
I'm in the financial industry as well. I have Blackstone, ticker BX. They're an alternative investment management firm. They do private equity, real estate, and this kind of thing. They've got projected growth rates of 30% plus for the next 2 years out. My near-term price target is $20. That is a 33% increase from today's levels. They look very good.
Also, I like this one too. Nice dividend on this one as well, about over 3%.
But you're only allowed one each week. So
1.5.
I've got a little time left. I want to come back to you on the earnings picture here. Any challenges that you see to the pace of growth?
Quickly, the challenge is that the stock market ran up so much in advance of earnings season, it might create too lofty of expectations.
All right, thank you all for being here, and thank you for being with us as well. We'll see you next time on Profit from the Pros.